Hi, and welcome to my very first video in my new video series that I'm calling My Two Cents. My name is Broske. I'm a certified financial planner with Pines Wealth Management in St. Louis, Missouri, and I'm so excited to be able to bring you this video series. My goal in doing these short videos is very simple: to educate my clients to help make them better investors. We're going to sort through the headlines over the past few weeks and discuss one or two topics that we feel are important for our clients not only to know about, but to possibly incorporate into their own financial plan, ultimately making them better investors. So today I want to start off with, unfortunately, I had hoped to start off with better news, but the last 9 weeks or so, investors have been dealing with one thing and one thing only: COVID-19. That's right. And so today's video, what I want to talk about is COVID-19 and how it relates to the markets and potentially the economy. And I want to talk about specifically bear markets, because in the meetings that we've had over the last couple of weeks, we've been hearing a lot about clients' concerns for bear markets. Have we entered into a bear market? Are we going? And if not in a bear market, are we going to enter into a bear market? But I want to talk about what's leading these discussions. And the Economic Bureau Analysis released their first quarter numbers last week, which has brought a lot of conversations up with clients, a lot of calls from clients about this number. The first quarter GDP number last week released was negative 4.8% in the first quarter, and that is no surprise to us. Essentially, when you had an economy that was humming along in the first half of the first quarter, come to an absolute complete stop for the second half of the quarter, a negative 4.8% GDP is what you're going to get. Compare that with last year, 2019, where we saw the GDP actually grow by 3.1%. It's no surprise. And I suspect that the second quarter GDP is going to be even worse than the first quarter, because we will essentially have one full quarter underneath our belts where zero economic activity happened. So the second quarter numbers may be even worse, but I'm not here to talk about that. I want to talk about bear markets and COVID-19. So let's start from square one and talk about what exactly is a bear market. Very simply, a bear market is defined as an equity market that has dropped 20% or more from its most recent high. And by that definition, the market collapsed from February 19th through March 23rd, where the S&P 500 dropped 30+% because of the headlines from COVID-19. That fits into a definition of a bear market. However, since March 23rd, the S&P 500 has recovered over 30%. So that clouds the discussion on whether or not we're actually in a bear market. Perhaps our activity from February to March was just a correction and not necessarily a bear market. But I want to talk about three types of bear markets that we could potentially see or could be potentially caused by COVID-19. And they are structural bear markets, cyclical bear markets, and event-driven bear markets. And let's talk a little bit about all three. Structural bear markets are very simple. They are the longest in length and have the deepest drawdown. Typically, you're looking at anywhere from 48 to 55 months in length. Average drawdown is about 57%. Structural bear markets, you typically see asset bubbles within structural bear markets. The most recent example that I can give you of a structural bear market was 2008, 2009. That was a structural bear market. We had a lot of problems that were bubbling underneath the surface that investors initially weren't aware of. And by the way, bear markets do not reveal themselves until many months after they've already passed. But in 2008, 2009, we had a lot of problems bubbling underneath the surface that were not only structural, but systematic. And as a result, you had a bubble that was created in housing. That bear market lasted from December of 2007 through March of 2009. The next kind of bear market that we see here, the second type of bear market, is a cyclical bear market. Now, a cyclical bear market is a little bit different. A cyclical bear market, very simply, is one that is created by rising interest rates and falling corporate profits. When you have those two factors in combination, more than likely you're going to get a cyclical bear market. A cyclical bear market doesn't last as long as a structural bear market, typically anywhere from 27 to 40 months. The drawdown here is about 31%. Now, right now, we certainly have one of those two factors in place for a cyclical bear market. Rising interest rates, we don't have that currently. In fact, the Fed has decreased interest rates to where we have interest rates near zero. And I don't anticipate the Fed starting to increase interest rates in the short term or in the near term. The other thing is corporate profits. Now, corporate profits, I do expect to decrease for the second quarter. When economic activity is near zero, that's what you're going to get. In fact, we've already had some corporations revise their earnings downward for the second quarter. And we've even seen some corporations not even report their second quarter earnings estimates. So you know the second quarter, you're possibly going to see numbers that are down and that are going to be a shock to the system. But the third type of bear market that we see is an event-driven bear market. And just exactly like the name implies, COVID-19 fits very nicely into that category. An event-driven bear market lasts only somewhere on average about 9 months. The drawdown is anywhere from 25 to 31%. So it's very short in its time. Now, event-driven bear markets, you can also have, I'll give you two other examples. Oil prices, the collapse in oil prices. That is an event-driven bear market. The other is 2018, 2019, where what seemed to be in the headlines every other day was the trade war, tariff war. That the higher the tariffs got at that point, you had a potential to create an event-driven bear market. And the reason why you need to know these what type of bear market we may be potentially in is simply to be aware and how that may impact your own investments. It's like we're a roller coaster family. And we've always, in the summertime, we've always traveled to these amusement parks. And one of the first things that we like to do is ride a roller coaster. And so when you ride a roller coaster, the first thing you do, especially if it's new, it's your first time riding a roller coaster, you look at the roller coaster and you look at the ups and downs and you look at the twists and the turns and you think to yourself, wow, this is going to be a good roller coaster. And when you see those twists and turns and ups and downs, it doesn't necessarily prevent you from riding the roller coaster, but at least gives you some expectations before you get on the roller coaster. And that's why it's so important to know potentially what type of bear market we may be entering or already in, is so that you can manage your own expectations so you can make better investment decisions. That's why it's important to know whether we're going to be in a cyclical bear market, a structural bear market, or an event-driven bear market. And last point here is just because we have entered potentially into a event-driven bear market, there's no rules that says that we can't then go into a cyclical bear market or an even longer structural bear market. We don't know if this event, if COVID-19 is going to lead us into those bear markets or not, but the more information that we have, the better decisions that we'll make. Thank you for taking the time to spend with me in these couple of minutes. We hope to be doing more videos in the next coming weeks. Be on the lookout for those. Be sure to follow us on social media, Facebook, Twitter, and LinkedIn. And don't forget to visit our website, www.pineswealth.com, where you can find a lot more information. You can also schedule an appointment with us anytime. Stay safe, stay healthy, and I look forward to talking to you in our next video.